Hey everyone, welcome back to Corporate Decoder, the place where we unravel the secrets hidden within corporate filings a bit too complex for your average financial news report. And today we're diving deep into the world of bond funds, specifically looking at the Dreyfus Institutional Reserves Fund's semi-annual report that has got some interesting numbers on how they manage money. Alright, so what we have here is a look at Dreyfus Institutional Preferred Government Money Market Fund, and it is telling us how they've been doing over the last 6 months, ending the 30th of September 2025. Think of this as a quarterly checkup for a big investment fund showing us where their money is and how it is performing. First off, let's talk about what it costs to keep this fund running. For a hypothetical $10,000 investment in their institutional shares, the cost over these 6 months was just $5. That translates to a tiny 0.10%. For the Hamilton shares, it was a bit higher at $8 or 0.15%. This is super low, especially when you consider the fees were even lower because the investment advisor helped out by waiving some expenses. It is a good sign when they can keep costs this low for investors. Now, how big are we talking? As of the 30th of September 2025, the fund had a massive $308 million under management. That is like $36 billion. And they held 141 various investments. That is a lot of money and a lot of different places to put it. Let's peek at where this money is actually invested because this is where the real story is. They have a significant portion, about 15.9% in US government agencies' obligations. These are things like bonds issued by federal farm credit banks and federal home loan banks. They've got a ton of these with varying interest rates and maturity dates, mostly coming due around the 1st of October 2025. For example, they have a federal farm credit bank's bond maturing the 1st of October 2025, paying 3 months SOFR plus 0.10%, and it is worth $45 million. Then there are others, like federal home loan bank's bonds, also with short maturities and rates tied to SOFR. The secured overnight financing rate, it shows they are heavily invested in short-term debt from government-backed entities, which is typical for a money market fund seeking safety and liquidity. Then we see a big chunk, nearly 30% in US Treasury bills. These are some of the safest investments you can get backed by the US government itself. They have a lot of these bills with different maturity dates in October, November, and December 2025, and even into 2026, for instance. They hold $325 million in Treasury bills, maturing the 9th of October 2025, an annualized yield of 4.07%. Then another $694 million maturing the 14th of October 2025 with a yield of 4.18%. These short term Treasury bills are a cornerstone of any government money market fund because of their extremely low risk profile. Following that, they have about 7.8% in US Treasury floating rate notes. These are also government-backed, but their interest payments can change based on a benchmark rate like SOFR. Think of them as government bonds with adjustable interest rates. They have a large position here as well, with notes tied to 3-month USBME, which is the US Treasury bill money market yield, plus a spread. For example, a note maturing the 1st of October 2025 with a rate of 3-month USBME plus 0.10% is valued at over $500 million. They also hold a smaller portion, about 2.7% in US Treasury notes. These are longer term than bills, but still considered very safe. These notes have various maturity dates ranging from October 2025 to September 2026, with different interest rates on them. For example, a note maturing the 31st of October 2025 is paying 0.25%. Another one maturing the same day is paying a much higher 5.00%. This variety in rates and maturities suggests a strategy to capture different points on the yield curve while maintaining safety. Now here is where things get really interesting and make up the largest part of their holdings, a whopping 41.3% in repurchase agreements. These are essentially very short-term loans where the fund buys securities with an agreement from the seller to buy them back later at a slightly higher price. It is a way to earn income on cash that is not immediately invested. They've got massive repurchase agreements with big names like Banco Santander, Bank of America Securities, Barclays Bank, JP Morgan Securities, and Sumitomo Mitsui Banking Corp. For example, a repurchase agreement with Banco Santander SA through Banai. For $2 billion maturing the 1st October 2025, fully collateralized by various mortgage-backed securities and US Treasuries. These are short duration agreements, mostly due at the beginning of October. This high concentration in repurchase agreements is what really defines a money market fund's strategy for earning income on its cash. Overall, the total cost of their investments is over $35 billion, and the value matches that cost at pretty much the same amount. This is a good thing. It means the value of their holdings hasn't dropped below what they paid for them. Looking at the statement of assets and liabilities, we see that on the 30th of September 2025, the fund had assets worth over $36.3 billion, but liabilities were only around $16.8 million. This means the fund has a huge amount of net assets, which is the difference between assets and liabilities. Over $36.3 billion. And the really important part for investors is the net asset value per S-share. For both institutional shares and Hamilton shares, the net asset value per S-share is exactly $1. This is the goal of a government money market fund, to keep that NAV stable at $1. It shows they are successfully maintaining that target. The statement of operations tells us about the fund's income and expenses over the 6 months. They earned a massive $702 million in interest income, after paying out expenses like management fees and shareholder servicing costs, which totaled around $17.5 million. Their net investment income was over $685 million. This is the profit generated from their investments. This massive net investment income of $685 million is what allows the fund to pay out distributions to its shareholders, keeping that NAV at $1 and providing income. Now, let's look at the financial highlights for the institutional shares over the 6 months ending the 30th of September 2025. The net investment income per S-share was about $0.021, and the distributions paid out were also $0.021. This means all the income earned was distributed, keeping the net asset value at that stable $1. The total return for this period was 2.15%, and that is not annualized, meaning this is the actual gain for that 6-month span. The ratio of total expenses to average net assets was a mere 0.10%. That is incredibly low and shows the efficiency of managing such a large fund. For the Hamilton shares, the numbers are very similar. Net investment income per S-share was also $0.021, and distributions were the same. The total return was a tiny bit lower at 2.12% for the 6 months. Their expenses ratio was a bit higher at 0.15%, but still remarkably low. The notes to the financial statements give us more detail. It clarifies that the fund is a government money market fund and aims to maintain a constant NAV of $1. They value their investments using amortized cost, which is a standard practice for money market funds, and this is generally considered to approximate fair value. They also discuss market risks like interest rate changes, and the risk that counterparties in repurchase agreements could default. However, with the extensive collateralization and the strong government backing of most of their holdings, these risks are significantly mitigated. Looking at this report, the Dreyfus Institutional Preferred Government Money Market Fund is a powerhouse of stability and income generation. Their strategy of heavily investing in short-term, highly liquid, and safe assets like US Treasury bills, agency obligations, and repurchase agreements with major financial institutions makes a lot of sense for preserving capital and generating income. The incredibly low expense ratios and the consistent NAV of $1 per S-share are a testament to their efficient management and robust operational framework. While there is always market risk, their portfolio composition suggests they are well equipped to navigate economic changes and maintain their objective of providing stable returns and liquidity. Alright, that is our deep dive into the Dreyfus Institutional Reserves Fund's semi-annual report. What do you think about their investment strategy? Are you surprised by how large these funds can get and how low their costs are? Let me know in the comments below. If you found this breakdown helpful, give this video a thumbs up and subscribe to Corporate Decoder for more insights into the world of corporate finance. And hey, if you want to connect with other finance enthusiasts and get even more exclusive content, make sure to join our Discord community. The link is in the description. Thanks for watching, and we'll see you next time.